Hey, welcome everyone. Tom here, CEO of Park Avenue Trading. For those that know me, I want to wish you a good hello. For those of you that don't know me, I'm a retired chief Forex trader with over 35 years experience trading foreign exchange, currencies, some bonds, and things like that. In this video, I'm going to cover the topic of leverage. So people asking questions about leverage. But I don't really think you're here to learn about leverage because it's a pretty simple concept. I think that you're here to discover ways to increase your account value, and I'm going to address that because it really doesn't have anything to do with leverage itself. Okay, leverage is leverage, but there are methods that we can use, actually, really money management methods that we can use to actually help increase our account value. I'm going to go over a couple of those with you here today. So before we dig into the nitty-gritty, please take a moment to hit the like and subscribe button. It helps a lot. Google, the algorithms love that stuff. It's going to help me out, and it ensures that you're not going to miss anything that I put out that should give you some valuable insights. Okay, now if I'm just going to go straight to like the chat GBT version of leverage, you're gonna hear about leverage being a powerful financial tool used by traders to maximize their profit potential in the foreign exchange market, and enables individuals to control a large position by only placing a small portion of their required capital, known as margin. This allows traders to magnify their profits, but opposes, big risks to losses due to the nature of the Forex market, because volatility, basically, it's a two-edged sword, right? Blah, 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 blah. You're going to find all that stuff. But really, I don't think that you're here to talk about leverage. I think that you're here basically to talk about, to learn or discover different ways that you can magnify your trading profits. And there are several ways that you could do it, and you do it through money management. Okay, now a lot of people say that money management is boring, but it's really not. It's really the engine that drives your total account. So it's quite an exciting bit of I'm stuck there a little bit. It's kind of an exciting piece of the machine that you need to make sure that you're making money, how you make money basically, and driving your account forward. It's a really important piece of your trading system. So I never really had to think about leverage when I was a bank trader, because there was no such thing as leverage. I would trade 5, 10, 20, 30, $40 million. It didn't make a difference because we were trading bank to bank. So leverage really never came up for me at that time, because I didn't need to think about it. But what I did think about was ways to increase my profitability and ways to protect my P&L, my capital, because we're all given as bank traders what's known as a global limit. Okay, you can only trade up to so much, or have out there, how much risk you can have out there, so much. It was plenty of money. I never really went near my global limits, because you don't want to ever go over global limits. And also you had a stop loss for the month. So I make up a number to make it just sound more rational for at-home traders, retail traders. The number would say would be like $100,000. Okay, so if you reached $100,000 for the month, you have to go to the treasurer and say, hey, I hit $100,000 stop. So that's something that you had to be cognizant of. So the way to basically overcome this was, I needed to figure out ways that I can increase my profitability and also keep my my risk kind of the same. So I'm going to go over ways to do that. And one of the ways to do that is, actually to understand Kelly criterion. Now, Kelly criterion basically was a way of looking at the marketplace through a gambler's theory. Okay, it was basically set up by I think his name was John Larry Kelly or something like that. So you could Google it. There's books that this man has written, and the formula really came out in like 1956. It basically, like I stated earlier, and I know I'm repeating myself, it came from like a gambling background, and it helped to determine the optimal bet size, so that you can find what the ideal investment size is. So the Kelly bet size was found by maximizing the expected geometric growth rate of, your trading system. Now, the Kelly formula basically said, you either win or lose, and the size of the win-loss ratio is the same. However, in trading, we should expect our wins and losses to be of varying sizes. So a more deep formula basically is optimal F. And optimal F comes into play according to Ralph Vince. Ralph Vince was the guy who basically came up with optimal F, and it calculates the size of a trade with the biggest loss and wins from the set periods. So optimal F money management was divided by Ralph Vince. The Kelly criterion was divided by Kelly, and there's several books written about other money management issues. Using these type of formulas. But the idea is that with the optimal F formula was a little bit more advanced because it took into consideration that the wins and losses weren't going to be equal. Like the Kelly criterion was saying that the wins and losses were going to be equal. So this optimal F is saying no, they're not. So optimal F looks for the ideal fraction of money that you allocate per trade based on past performance. So if your optimal F is 18%, then each trade should be 18% of your account value. No more, no less. So it's kind of like a fixed fraction or fixed ratio methods, but with a few differences. Now, in the description below, I'm going to put a link to an optimal F calculator. So if you know what your win-loss ratio is and what you can figure out what your optimal F is. Okay, you could basically plug into the calculator, like if I'm going to allocate 10% of my account per trade, what will be the outcome? Okay, now you got to remember, when you're allocating 10% of your account per trade, when you take a loss, you're hitting 10% down. Okay, so the drawdowns are, my buddies on the desk used to say, optimal F is optimal F. When you get F'd, you're F'd. So it's again, that's kind of a double-edged sword. So I offered you, you could read books on the Kelly criterion to help you. And you could definitely start to read books on optimal F. Because, like I said, leverage is not really what this is about, okay? Leverage, you're going to get 50 to 1 in the States. You can get 200 to 1 over in Europe on some brokers. But the idea really isn't the leverage. It's really understanding what your win-loss ratio is and how much money you should allocate per trade. That's what's going to increase your account value. That's what's going to drive. That's the driver, the engine to bring your account forward. So money management really isn't boring. Money management is very, very exciting, because once you delve into money management, you got to start to understand that that's really what saves your ass, and also what exponentially can grow your account. So in this video, I'm also going to go over what I use and what I think that will be a good basis for you guys to use, and that's called fixed delta ratio. Okay, and I'm gonna, right now I didn't write the slides yet. I'm gonna pause this. I'm gonna write the slides. I'm gonna go over fixed delta for you, and then you can start to understand that really it's not leverage that does it for me. Because if you just go into this game looking for the maximum leverage, and then you throw the biggest trade out there that you can, thinking that's because I could trade $200,000 with $3,000. I'm just making it up. And you put a decent stop on it, and the market gaps, it's going to wipe you out, and you're going to owe money, because you're trading way too large for what you have. So there has to be a balance, okay? And leverage isn't the key to drive your account forward. It's money management. So let me set those slides up. I'll come right back. Okay, so I just finished the fixed delta basically a table. It's a very simple system. I'm going to go over that with you in a second, but I just wanted to clarify, I could not find the optimal F calculator online. It seems to, there's no more links to it. So I put up the Kelly criterion calculator. That basically also takes into idea of losses. So it's almost as good as optimal F. Optimal F basically just determines the position size, what size you should have. You know, Kelly criterion kind of does the same thing. Ralph Vince obviously says that his calculation is far superior to the Kelly calculation. You could go and read about this stuff, and that's what I suggest that you do. The whole idea of this video is to get you to start to understand that it's not really leverage that does this for you. It's really money management, and that's the key that I want to get to here. So I'm going to go over the fixed delta system right now, so stand by. Okay, so this is what's known as fixed delta system. And it's a very simple system. Now, there is, before I go any further, okay, you really need to know what your win-loss ratios are. So that's like another video, but you can easily figure out, you can actually Google, like, how do I determine my win-loss ratios? Basically, it's basically taking your trades and all the number of winners you have as compared to the losers of overall trade. You come up with your win-loss ratio. Then you basically have to come up with expectancy. All right, so how much do you win versus how much do you lose? You need a positive expectancy. Okay, so you need to win more than you lose. If you have a problem with that, you have a problem with your trading. So it's not really so much, nothing's going to do with money management. It's not going to help, because you're not going to be able to do fixed delta if you don't have a positive expectancy. If you want positive expectancies, you're going to have to buy a trading system from me if you don't have one. Hint, hint, hint. Just kidding. Well, actually, I'm not kidding. You know, I have some really good positive expectancy trading systems, but that's for at the end of the video, when I direct you to go to Park Avenue Trading, you could check out my stuff there. But anyway, so what fixed delta is, you know, first thing you have to do is you have to determine what the delta is going to be. So delta in Greek means door. It also means change, right? Mathematics, it means the change. So you determine your delta, okay? Now, the higher your delta, the more conservative the risk is. So right now I'm using a hypothetical account of $100,000 balance, and this trader has determined that his delta is going to be $3,000. So for every account increase of, the first account increase of $3,000, the account needs to go to 103,000 before he can trade 2 lots. So he's starting off with a 1 lot trade per $100,000 in this account, and he's saying that I need to go up $3,000 in order for me to trade 2 lots. Okay, so once he gets to 3,000, it gets the account balance up to 103,000. He basically could trade 2 lots. At that time, you have to multiply 2 times $3,000. The delta, you're going to come up with $6,000. So in order for him to advance to 3 lots, he needs to take the $6,000, the change in the delta, adding it to 103,000, he comes up with 109,000. Once the account value reaches 109,000, he could trade 3 lots. Just moving forward, it's very simple. So now he has 109,000, he's trading 3 lots. Okay? He's going to take 3 times 3,000, he's going to come up with 9,000. 9,000 plus the 109 gives him $118,000. He cannot advance his lot trading until he reaches $118,000 in account value. Then he can go up to 4 lots. So you can see that we're increasing our trade size according to what our account value is really what you should be doing, and not so much looking at leverage. Okay, so that's an important thing. Now, you could keep doing the math. I'll keep this up a second. I'll just talk with this up. So, you know, you reach 18,000. You're going to take 4 multiplied by 3. You get 12,000 plus the 118. You need to get to 130,000 before you could trade 5 lots, etc., etc. Now, what happens if you're at 130 and you drop back down to 118? Well, you go back down to the smaller lot size. So you start decreasing your lot size if you start giving back profits. Okay. Now, ultimately, you should be looking at, like, if you have a decrease in account size, if you have a tremendous amount of losses coming in and it doesn't seem proper to you, you should stop. Before you go back down to 118, you should start to reevaluate, like, what's going on. Try to figure out what's happening. Is it a psychological issue with yourself, or is the trading system breaking down for some reason? And all trading systems can break down. That's just part of, novice trading systems. Okay, so you need to get, I mean, I don't keep trying to hammer home the issue, but you need to find if you need to have help building a trading system, you need to find somebody to help you build them. I'll help you. But okay, so here is the fixed delta. Now there's a couple of other money management systems that you could use aside from fixed delta, but I think this one is a very, very good. It has no subjectivity. It's basically, this is it. The delta is 3,000, or delta is 2,000, or delta is 1,000, or delta is 7,000, whatever it is. However, whatever your risk appetite is, it is, and you just plug this in, and you know where you're supposed to be and how much you're supposed to be trading at any one time. Now, there's another variation of this, and I don't suggest it, but I'll mention it. So let's say, for instance, you figure out you have a frequency of trades, and let's say that for whatever reason you come up with a frequency of 7 wins, and then you go in through a drawdown phase where you get three or four losses in a row. So what you could do with that is you could say, okay, I'm going to trade fixed delta, and I know that I'm going to be trading let's say you make it up to 103,000. You're trading 2 lots, and you're doing well. You're moving forward. You got your 7 wins, okay, and you think you're due for a loss, because now it's it's kind of a bunch of hooey, but it isn't a bunch of hooey, because frequency does happen, but you just never know when frequency is going to happen. It can happen at the beginning, it can happen at the end, but what you can decide to do is, like, as you start taking losses, basically you can start ratchet downing your trade size until you start catching a win again. And you could use fixed delta for that. So let's say you're trading 2 lots, and you're up to 105,000. And you need to get to 109. Also, you take a couple of losses, you back down to, like, say, 104. Okay, so what you could definitely then do is say, okay, I'm gonna ratchet down to 1 lot until I get 2, 3 winners in a row. And once I do that, then I go back to my full 2 lot trading. Okay, so you could put, like, safety brakes on it. All right, and like I said, money management is really the engine that drives your account forward. It's not leverage. All right, so I hope that I offered you something in this video that was useful for you. I ask you to go over to Park Avenue Trading to make sure that you can sign up for our emails. You get a free book, a free gift. There's some really cool blog posts there. Any type of questions you have, you can even email me. I'd be happy to answer some of your questions through email. I really want to help you move your account forward. Again, please subscribe for this button for this channel. I'd like to develop my subscribers, and also, like, you don't want to miss out on some good content that I could put out. So I look forward to seeing you in or on the Park Avenue Trading website. Cheers.